Hi, Advanced Accounting. In this video, we are going to go over different methods to figure out ending balances. Okay, so there's the simple equity, there's the sophisticated equity, and there's the cost method. Please make sure that you've taken notes on my PowerPoint so you understand the different methods. Because depending upon which method that the company chooses, they will come out to different numbers. In the end, when they consolidate, all of these lower level entries will get eliminated so they can choose any method that they want. All right, so here's the problem that we're going to look at. It is the following. A parent company paid $500,000 for a 100% interest in a subsidiary. At the end of the first year, the subsidiary reported net income of $40,000 and paid $5,000 of dividends. The price paid reflected understatement of equipment of $70,000, which will be amortized over 10 years. I don't like that word amortized. It should really say depreciated, but I'm working from your textbook. What would be the subsidiary income reported on the parent's unconsolidated income statement, and what would be the parent's investment balance at the end of the first year under each of these methods? Okay, so you need to understand the methods, so make sure you know the different methods. So again, go back to my PowerPoint so you understand what you do with each of the methods. Okay, so let me go over here and let me do debit and credit. For each of the methods, it doesn't matter. The first journal entry will always be the same. Okay, so how much did they pay for this subsidiary? They paid $500,000. So you would debit investment in sub 500,000, and you would credit cash. That is always the first journal entry when a parent purchases a subsidiary. Okay, but depending upon the method, you're going to take into account different items. So let's go over the simple equity method first. All right, first off, if you look over here, here's this base, and this is an easy way to determine the investment account. So the simple equity, the investment account, you're going to start with 500,000. That's your first number. Okay, so that's your base. Let me do it in blue over here. This is your 500,000. This is for the simple equity. Simple equity, you are not going to take into account any depreciation or amortization. It's the sophisticated equity that you take into account. All right, but you will add in any net income. How much do they own? They own 100%. If they only owned 80%, you would multiply that 40 by 80, which is the net income, but they own 100%. So that's going to go over here. Let me just show you the base over here. What I'm showing you is how to figure out the investment account. Okay, next, it says that they paid dividends of $5,000. When it's the simple equity, dividends will subtract from the investment account. They will subtract. So you will go over here and you will subtract out that 5,000. And then finally, that will give you your ending. So for the simple equity, the investment account is 535,000. So let me just erase this now. That was your beginning. And we're going to put in 535,000 for the investment account. Okay, so then it also asks you for the net income, or just the income of sub, right? subsidiary income. All right, so for the simple equity, your answer will just be $40,000, okay? All right, so it would just be $40,000. That would be your answer, okay? All right, let's look at the sophisticated equity. Sophisticated equity will take into account depreciation or amortization. This is the simple, so this is the sophisticated. I will just bring over this 500. I'm going to start with that. However, the net income is now not 40. I'm going to take 40 and I'm going to subtract out 7,000. Let me show you how you get the 7,000. So let's look back at the problem. They had paid $70,000. Do that over here. Here's the asset, 70,000 divided by 10 years, and you're going to figure out, the book calls it amortization, it's depreciation, but let's call it the same as them. Amortization of 7,000. Well, that will affect your 40. So you're going to take 40,000 minus 7, and that gives you 33,000. Next, you'll still subtract out any dividends. However, when it's the sophisticated equity, your answer to the investment account is 528,000, not 535. Your answer to the net income is not 40, it's 33,000, because you subtract out amortization. That's going to decrease your net income. All right, let's look at the cost method. That's the easiest method of all. The only piece that will affect the subsidiary's income is dividends. Okay, so dividends for the cost method, you would debit cash and credit dividend revenue. For the sophisticated equity method, they would debit cash and credit the investment account. Okay, so that method, dividends subtract from the investment account. For the cost method, it doesn't touch the investment account at all. So for the cost method, you would just have this first journal entry. So your answer to the investment account would be 500,000, because that's the only piece that affects the investment account for the cost method. You would not, for subsidiary income, any net income of the sub would be 0. Do not include it. However, when I just went over that dividend revenue, you would have dividend income, and that would be for $5,000. Okay, so that would affect the parent's income statement, but just for that dividend income. Okay, and that's how you do that particular problem. You will have a similar one to do for homework. Okay, I'll see you soon.